Welcome back, everyone. On this episode, we have an interview with Brian Barnes, the founder and CEO of M1 Finance, a stock brokerage platform based out of the US. I asked Brian Barnes to come on and talk to us, not so that he could advertise his services or products. That's not what this interview is. Rather, to discuss FTX, to discuss what went wrong, how regulations work, how they don't work, when people have their money at risk, when they don't, and to give his perspective, which I think is incredibly unique as someone that has run a fintech company for a number of years. So I hope you enjoyed this interview. I hope you learned something new from it. Let's go ahead and jump in. You founded M1 Finance and you're still running it. How much of what you do or have done over the past years involves government regulations?
Yeah, so I think I have two big domains of government regulation. So M1 is probably best known as an investing platform, and in the US that's regulated as a broker-dealer. And so started the company about 7 years ago and started the broker-dealer from scratch. So did the application process with the FINRA, they do new member application, interview process and the like. And so went through that, and I am one of the Series 24 principals. You have to have at least two. We probably have, 15, 20 at the firm right now, but one of the firm's principals. And then on a separate realm, I individually purchased a small nationally chartered bank. And so that's overseen by the Federal Reserve for the bank holding company, and then the OCC for the bank itself. So I have exposure to both the broker-dealer side of the world, the banking side of the world, enough to be dangerous. I'm not, like a securities lawyer or anything like that. So, and I would say I have very limited knowledge of sort of international laws and regulations. I
M1 Finance is US only, right?
That's correct. Yep.
Okay. All right. Well, no, I mean, even what you said there shows me, like, I feel like I have some understanding of brokerages, and I get some things, I think, a little bit more than most people, but your understanding of it is way further. So I think this will be good. Let me go ahead and start off with some questions here. I want to again talk about FTX. This is a subject everybody wants to know about, and I think you might have some interesting perspective. When you saw this unfold, just a general question here. When you saw this unfold over the past week, what was going through your head with your running a fintech company, running this type of operation?
So I think I was equally shocked as with everyone else. I mean, 2 weeks ago, FTX was held up as the pinnacle of success in the fintech area. They, the fact that the CEO, SBF, would be on the speaking circuit, front of every magazine, going in front of Congress, I definitely didn't get any bad feelings that this was a fraud, a sham, or anything like that. And so, I think I had very similar perspective, and for the idea that they went from the shining light to, a potential giant Ponzi scheme in a matter of a week, it was pretty eye-opening and shocking.
Yeah, I think that was what was most unsettling to most people is you get these news releases that they're trying to buy other companies. They have billions of dollars of extra money to spend, tens of billions of dollars, and the next day they're totally bankrupt. So it's good to, it's interesting to see your perspective on that. I want to read something that Sam Bankman-Fried said, and he said this in a Twitter message. This was just revealed a day ago. I think he was talking to someone. He obviously didn't know this was going to come to light. But the person he was speaking to messaged Sam and said, "You said a lot of stuff about how you wanted to make regulations just good ones. Was that pretty much just PR too?" And Sam responded to that saying, "Yeah, just PR. F regulations. They make everything worse. They don't protect customers at all." When you hear him saying that in private, what do you think about his assessment of regulations?
I think most, if not all of this happened due to lack of regulations. And this is having started to find it, in the banking and brokerage space, I've definitely complained about regulations. It makes life very difficult. It makes it hard to run a business. There's definitely areas where, we have to dot I's and cross T's 15 different times to sort of take a step forward, whereas, other companies don't.
It slows things down, right?
Yeah, no, it definitely slows things down. But I do think, and I was talking with an employee before this, they impose the cost of regulations because there are bad actors out there. And the bad actors, like in some sense in the traditional finance space, we had issues in the Great Depression. We had issues in the savings and loan crisis. We had issues in the 2008 Great Recession. And every single time the huge bills pass Congress, they enact a whole new set of rules and regulations. It's a very robust consumer protection framework. And then they have regulators that audit you with intense scrutiny. And so all U.S. financial service firms have to obey and adhere to just a extremely long litany of rules and regulations that, I do think they do have the best intentions in mind. At times they're onerous and difficult to adhere to all of them, but then you have a principal that checks, that grades your homework and make sure that you're doing all of it. And I do think there is an aspect, there's a reason that FTX was domiciled in the Bahamas, and it was to not be subject to the intense rules and regulation and scrutiny of the regulators. And, so I disagree vehemently with the statement that they're not there to protect users. I think this is a very clear example of the blow up was only permissible by the fact that it was not under the view of a financial system that would protect against issues like this.
Yeah, obviously, I think that's, now it's counter evidence. Like everything, he's blasting regulations, and then this is the outcome. But I had, I don't have as much understanding of the regulations, but I at least, every time I see something, I feel better about knowing it's more regulated. With crypto and stuff, part of the appeal is like less regulations, and it's kind of the Wild West. But what I've seen over the past week, I took on a sponsorship to advertise FTX US's stock brokerage, which is a platform based out of the US, a stock broker. And what I've seen since the whole company collapsed because the international business went under, it dragged down the rest of it, including the US businesses. The people that used the regulated stock brokerage, the company that was actually licensed in the US with the regulations, have already received their money back. They've given instructions on how to log in. You can go in and get your money back. I actually had $2,000 on the platform, and I retrieved it, and a few other people. So when I was looking at this, I was actually concerned. A few days ago, I was thinking, if I can't get my money back on this, and this is regulated, right, the U.S. stock platform, that was going to be something that was really concerning. But I actually saw the process work out a little bit, which was interesting to see. To dive more into the regulation aspect, I just want to go over, because this transition of Sam Bankman-Fried is one of the most incredible transitions ever. When you see how big of a facade and just overall a fraud a person is transitioning when things get exposed. Just up until a week ago, Sam Bankman was viewed as a benevolent billionaire, like the most charitable guy. There was YouTube videos, people interviewing him. He was talked about by the media at large as doing good for the world. He was giving away money left and right, doing all these donations. Now that FTX has collapsed, we have some information coming to light just recently. This is something today. And here's some stuff we learned from the bankruptcy. I want to go over a list of it. FTX lent Sam Bankman over $1 billion for personal use. FTX used customer funds to buy houses for employees. FTX didn't have a list of employees and what they all did. FTX did not keep any books or records of its digital assets. Alameda Research was exempt from the auto liquidation on FTX. FTX built software to hide the misuse of customer funds. All of this is in the bankruptcy again. You can go through, and this is what they're detailing out. FTX had $400 million in unauthorized transfers the day they filed for bankruptcy. FTX had billions in investments other than crypto, but there were no books or records of any of it. And Sam Bankman made all business decisions on apps that auto-deleted everything after some time. So quite the transition from Sam a week ago to Sam now. We've learned some new stuff. But the problem for me and other investors, other people that are putting our hard-earned money, right, on these platforms, it comes down to a level of trust, and not just trusting CEOs because they can have such a good image, right? Like I look at you and I think you're a trustworthy person from what I can see, but I don't know you too much personally. I have basically all of my life savings on M1 Finance. I have about $500,000 on it, about 500,000. So it's basically all of my assets on a platform. And when something like this collapses, I have to feel like I have as many insurances and guarantees as possible. And I think there's other people in the same situation that they look at this over here and they go, wow, this is scary. Even though they were, Sam looked he played the media so well, right? He played him like a fiddle and he said all the right things. Then we get all this information exposed that he was a total fraud. And so, even when we want to trust people, the question I have is basically, how do we ensure as investors, when we're putting our money on a platform, how do we distinguish and validate beyond just interviews and things CEOs are saying that this isn't going to happen to M1 Finance? They're not doing crazy things, Wealthfront, Robinhood, SoFi, or any other platform like that. How do we ensure that?
So truthfully, I do think there is a huge benefit to understanding that what companies are under the rule and jurisdiction of the United States government. That, in the US, if you're domiciled in the US, if you're going after US customers, you want to sell them stocks and ETFs or, any security, you have to become a broker dealer. That is the legal and regulated entity where that activity is permissible. And, happy to go into sort of the structure of how, the overall markets work with, we do have centralization with a central domicile of the DTC where all securities are. We have a clearinghouse function that provides stability so that, one firm doesn't cascade into others. We have brokerages that take customer funds, and the rules and regulations that they're subject to is just so exhaustive that it would be, we've had instances, so I don't want to say impossible, but I'm not smart enough to, figure out how to break them. I mean, from employees are, fingerprinted, they have to pass exams. There's minimum equity requirements. There's books and records requirement. You have to get independent audits from two different auditors, one for your firm, one for the broker dealer. It has to be from a PCAOB accredited institution. You have to store and archive every piece of communication. You have to have compliance officers look at that to make sure that nothing's happening. You always have to maintain equity buffers. So you have to buy a fidelity bond so that if you do anything illegal, someone else comes in and, covers losses. And then you do have regulators looking at it. And then you also have supplemental insurance through in the broker dealer realm, it's SIPC, and the banking realm is FDIC. But, that provides investor protection for up to $500,000, of which 250,000 can be cash. And so that's, cash. And then the $500,000 can be in securities. And so it is one of these, I don't know the silver bullet, but I do think the idea of it's a registered broker dealer in the United States, subject to all these rules and regulations, which are thoroughly vetted and audited in a pretty exhaustive fashion. I do think, should provide the level of stability and care and trust that the U.S. consumer deserves. And, it's something that regulators issues like this put the regulators do not want to have an issue like this happen in the United States. And so they do everything they can to make sure that it doesn't.
Yeah. From what I've seen, again, contrasting what's gone on with the stock brokerage that was based out of the U.S. that FTX created compared to their international business, it's just dramatic, the difference. People are recovering their funds because the stock brokerage is part of FINRA and they have the regulations. And then, the people in the international business, they're just waiting. It's in limbo. They don't know if they're going to get any money back. Yeah, I think
the other big thing that I would say is a lot of this also comes down to segregation of customer assets. And so in the event of a firm bankruptcy, where are the assets? And, I would say rule number one of finance is customer assets are segregated from firm assets. And so there is an aspect of every, if you have shares on any US brokerage, there is an account that holds those shares in the background. It's typically owned by your brokerage in what's called in street name, which means they own it in their thing. But there's a subledger that accounts for those shares directly. The big thing in FTX is those shares were not, or the tokens were no longer in their domicile. They had lent them out completely. And so they basically had a giant IOU that was representative of all the customer funds that should have been there.
Yeah.
I would say that's the first and foremost that, you can't do it in.
What they were doing, what I understand so far, is they were basically taking deposits of customers. They're using phony collateral that was like cryptocurrencies as collateral, like FTT and Serum and these coins that they basically, The value of it is it fluctuates so much. It's so volatile. And then they're using that to get loans. Between the US, what can you lend out? If you, on M1 Finance, what are you able to lend out? What practices are restricted that Sam was doing over in the Bahamas?
Most of the time, if you buy a security within a brokerage account, that individual security is on the books and records of the broker dealer, allocated to you in terms of ownership. And only in the cases of fraud would a brokerage firm go into there and use customer funds. And so, it's definitively illegal for that to take place. And it's only in the cases of fraud, which your fidelity bond would protect, supplemental insurance would protect, and SIPC would protect. There are instances where the brokerage or the clearing firm does have the authority to lend out customer assets. And a lot of that is around taking on margin. So brokerage margin is governed by this rule Reg T, and there are extremely strict rules about how much you can borrow collateralized against liquid investment securities that have gone through the process of IPOing, registering with the SEC as securities. And then there are very strict rules of sort of the equity buffer that you need to maintain at any given time to support that. And so if you bought 100 shares of XYZ on a broker dealer, and you said, I want to fund that 50% with brokerage margin, the broker then has the authority to lend out those 100 shares as collateral to come up with the cash for it. And the rules are you're allowed to borrow up to 140% of the customer's margin debit balance. And so there are so many confines and rules and reporting requirements associated with that. But that's really the only, that's when.
So basically margin is the only thing. M1 Finance is an introductory brokerage, right? And then you have a different clearing corporation that handles that. When I recovered my funds from FTX's thing, they did the same thing. They're an introductory brokerage to a different clearing corporation. I could just log into that and get back. And obviously, I don't think they were lending them out at all. I don't think they could, because it's based in the US. So it's good to see that work. I guess another thing is, this just brings in the question. And when people see one company like this go bankrupt, which is, I guess it's common with just crypto platforms. It seems more rare with just pure brokerages. But what does that process look like? If Robinhood just collapsed, or M1 Finance or Wealthfront did, right? Because of, you didn't get enough customer, whatever. There's not enough memberships or something and not enough cash flow. And the business was just mismanaged and it went bankrupt. What happens to my money? What happens to our money if that happens?
Yep, for sure. So I do think it's important to understand. So in the brokerage space, there's a central clearinghouse called the DTCC. They custody assets for everyone. They have, sort of a ledger that, here's where all the securities that are registered on exchanges are allocated. In a sort of concentric circle around that, you have, I don't know exactly how many, but it's in the hundreds, between 1 and 300 clearing firms. And then outside of that, you have broker dealers. And broker dealers, I think there's around 5,000 of them, and then they have customer clients. The very big broker dealers are what's called self-clearing. And so the Fidelities, the Schwabs, the Ameritrade.
That's when they do it for themselves, right? They control it in-house.
Yep. And so they have both a brokerage, which goes to customers, but then they also custody the assets themselves. And so and then they have the relationship with the DTCC. And the only reason that I say that is it does differ a little bit based on sort of that relationship. In the case of M1, we currently clear through a company called Apex Clearing Corporation. And they clear for Public and Webull and Stash and Betterment. And so they've developed a specialty in clearing for fintech companies. Yeah. The big thing is, if in our case, if M1 went bankrupt, the custody, the assets are still with Apex. And so there is you get protection there of, M1 going down, it's with Apex, and Apex is extremely well capitalized. They have the hurdles for becoming a clearing broker dealer are extremely high. You have to post a ton of equity capital to do that. And so that is one case. Robinhood, on the other hand, is big enough that they're self-clearing. And so
So they used to use Apex, right? I remember reading news that they moved from Apex to their own clearing corp.
Yep, exactly. Yep. So they started on Apex and they were there through probably 2020 and then transitioned off. I don't know if those are the exact dates, but and so what really matters is whether you're clearing firm goes down, not the introducing broker dealer, even though the introducing broker dealer, you would be protected by SIPC. In the case of a clearing firm going down, your assets would be protected by SIPC or fully insured by SIPC. That gives you coverage up to $500,000, of which that $500,000, $250,000 can be cash. And they're basically protecting that if you owned these securities at this clearing firm and it's established via the books and records, they will protect against any mismanagement of assets, any loss of funds and the like. And it's a insurance pool that all broker dealers have to pay into. And, it is basically there to support any issue. I did some research that in the history of SIPC, they've only had to advance $3.1 billion, but that recovered $142 billion of investor funds. And so, it's an insurance fund that sort of protects against losses, but a lot of the time the securities
they're there.
They're in the clearing, the clearing firm. Yeah.
Well, I know I have a buddy that worked as a CPA and he worked for a big four firm. He did a ton of audits and he basically said, the big thing we do with audits is just confirming the assets are there. We just make sure they have them. It's that's the top thing that you do is make sure they actually have the assets where they say they have them. We hear these things as customers and we don't have this immediate understanding of everything that goes in depth. But we see that some products have FINRA. It's supposed to be consumer protection, but I don't really know too much beyond that. I just know it's a layer of government, maybe, a government orchestrated protection. Then we have SIPC, and then we have FDIC. Beyond that, I feel like anything I put my money on that doesn't have these protections, I feel like there's risk involved. So is what I feel like, a lot of risk of, no insurances. Am I viewing that the correct way?
I think it is fair. I don't know if I would go. Those definitely provide a lot of insurances, both insurances and assurances. So in the broker-dealer realm, the regulated body that oversees everything is actually the Securities and Exchange Commission. That then oversees a group called FINRA, which is called a self-regulatory organization, which oversees broker-dealers. Okay. All broker-dealers then pay into SIPC, and then that SIPC fund is an insurance fund which protects against any losses due to firms going under. It's a very similar thing in the banking realm where banks are regulated by either the Federal Reserve, the states, the OCC, and they pay into a fund called the FDIC, and the FDIC insures those deposits against losses. And so those give you the absolute highest level of confidence. There are, and I'm not trying to diminish, but if people put money on PayPal or Venmo, those are platforms that don't have FDIC insurance. They're not banks.
I guess.
I would say those are quite safe, and they're supported by giant established companies with reputations and big balance sheets and audited financials and securities regulation. And so there are other ways to provide assurances, but I would say the further and further away you get from regulated entities, the risk definitely does go up.
Let me see. Do I have anything else? Is there anything else you can think of that you think's relevant to people? Mostly what I wanted to just go over is, I was at least a week ago, even before getting the funds settled, I was personally pretty unsettled by this. The fact that it was a broker dealer and it's okay, it might take forever to get the money back. Having that part be resolved though, I did think reflected positively on the rest of the industry, because that was a US registered brokerage and they're returning assets back very quickly. So that's all the questions I had.
Yeah. And I would say the only thing that I'll finally add is in the brokerage realm that protects cash and securities. The crypto community has gone very hard of the coins themselves, the cryptocurrencies are not securities. And truthfully, there's a little bit of a gray zone of don't know, but I would say it's very likely to assume that those are not protected by SIPC. And so I think it's worth putting out there that cryptocurrencies are very likely not considered SIPC protected, even if they're sort of trying to be domiciled in a brokerage account. There are other rules and regimes of trust companies, bit licenses, and they're regulated by, states. The New York bit license is a huge one. And that is where, that's where Coinbase interfaces. That's where, Bitwise. And there is an aspect of people deciding to domicile in the United States is a signal that they're saying, I am willing to subject myself to pretty onerous rules and regulations because I'm doing everything right. And there is an aspect of, people who go to the Caymans, the Bahamas, it's a red flag of, I don't want to.
Being founded in the Bahamas is basically a red flag. We want the least amount of regulations, right, as possible. And having your headquarters in the US is the opposite. You're being subject to everything.
You go to the Bahamas and you say, there are some rules I don't want to adhere to, is sort of the signal that you're giving off. There are plenty of firms that operate above board and morally and ethically that do that, but it's definitely riskier.
I appreciate you coming on. I just wanted to get your thoughts on it. I feel a lot better after this week. The fact that the system in terms of the brokerage works. So, it was a bit unsettling to see it happen, but in terms of the actual regulated portions of it in the US, I felt like it got resolved relatively quick. So, but that's all the questions I had. Appreciate you.
Yep, for sure. No, and then there are lists of firms that have filed for SIPC coverage, that have filed for FDIC coverage. The number of banks that have gone belly up in the last 15 years is, you could count them on two hands. Same thing with brokerage firms. And so it should give people assurance that the system is working. While we love the decentralization, the rule of law that has gone through financial crises, come out the other side, had preventative measures to protect it. It does strengthen the system overall.
My spirits were lifted a little bit on that. I really would have felt really just unsafe with my investments if this didn't get recovered. If the stuff from FTX's brokerage, if that never got recovered and the clearing corp didn't recover the assets, that would have just changed my thoughts on it. But I do think this shows, at least right now, the system is working. The regulations do work. So, well, I appreciate you coming on. Thanks.
Cool. Thank you for having me.